Struggling to find profitable apartment buildings for sale can feel like searching for a needle in a haystack, especially when every wrong decision threatens your financial stability and your financial security. Many investors face the fear of missing out on the best deals, or worse, sinking money into the properties that turn into money pits. In this video, we'll share the proven strategies to help you navigate the multifamily market with confidence and identify the most lucrative opportunities, ensuring you make smart, profitable investments every time. Let's dive in. My name is Stacy. Welcome to the RMFI Academy, where we empower working professionals to achieve financial autonomy through multifamily real estate investing. So let's start with talking about your investment goals. So you want to know, what are you trying to accomplish? Because you always want to begin with the end in mind, right? So what are your short-term goals and what are your long-term goals? And let me give you some examples of this. So sometimes when people come into multifamily, they're coming in to build generational legacy wealth. So if that's the case, the decisions that you make and the properties you're going to buy are going to be different than if your goal was to create as much equity as possible in the next 5 years. So it's important that you be highly associated to what you are trying to accomplish, because everything you do, your market research, the way you analyze deals, the types of deals you analyze, are going to change depending on what you are trying to accomplish. Another thing you want to think about is, what is your risk tolerance? Are you the type of person that's like, yeah, let's just go for it, go, go, go? Or are you a little bit more like, ooh, I want to be really careful, I want to be very cautious? And the thing is, there's no right or wrong. Obviously, the happy place is somewhere in between, which is why most people end up working on a team when it comes to multifamily real estate. So with risk tolerance, I'll give you an example of this. Let's say I see a 10-unit apartment building and it's completely vacant and no one's lived in it for 5 years. And I have the opportunity to go and buy it for an incredibly low price, renovate the whole thing, rent it out, and just really maximize the value of it. Like, I'm gonna make a ton of money on it. The reality is, projects like that come with a much higher level of risk, because anytime a property's been vacant for any long period of time, there's all sorts of things that could be wrong that you're not necessarily gonna find or know about because there's nobody living there. So if you're on the opposite end and you're very nervous and you wanna make sure everything is just right, then you're gonna probably be buying something that is already stabilized, meaning on day one, it's already cash flowing, there's already residents there, you have property management in place, and you're really not doing much, but just continuing on the ownership. You put your down payment, you got your financing, and now you own it. So depending on what your risk tolerance is, you might tend to go more for stabilized and safe, lower returns. If you're a little less risk averse, you might go the way of value add. And depending on how risk averse or not you are, you might go into different levels of value add. So, for me, I tend to fall a little bit more towards the conservative side. So my favorite type of property, I'm always going to look for opportunities to add value. To me, there's no point in doing real estate if you're not going to try to increase the value. That's just me. So what I look for is, I look for properties that are already cash flowing or at least breaking even, but there's also some upside. So the verbiage I use for that when I'm talking to brokers and telling them what I'm looking for is, I like stabilized assets that are between 35 and 70 units that have value add opportunities. So that fits my risk tolerance. As you get more familiar with yourself as an investor, you're going to understand what your risk tolerance is, and that will drive the type of properties you look at. And it's important to do that early and to know that early, because when you're communicating with brokers about what you want, the clearer you are, the easier it's going to be for them to go and find what you're looking for and provide it to you. Another important thing is knowing what your budget and financing options are. So what you want to look at is, how much capital do you have available? Now, if you were going to do the deal by yourself, then you really have to look at your capital as that's it. Generally speaking, lenders are going to lend somewhere between 65 and 72% loan to value on an apartment building. So you're going to have to take the amount of capital you have, knowing you got to keep reserves, right? So how much capital do you have available to put as a down payment, and basically divide that by 0.65. That's going to tell you the amount of property you can afford to buy. Now, I never recommend people do that because it really limits you, unless you have tons and tons of cash. And if you do, right on. But most people don't. And if you don't, you're really limited by the amount of money that only you have. And frankly, what about the next deal and the next and the next when you've already used your capital? All right, let's talk a little bit about researching the market. Now, in other videos I've done, we went deep into how to analyze the market. So let me just give you some key points right now. You're always looking for markets that are, first of all, landlord friendly, not tenant friendly. And beyond that, you want to have areas where the numbers make sense. So there's this thing called the 1% rule, where you want to make sure that the market rents are 1%, at least 1% of the purchase prices. So for example, if I'm in San Diego, California, and I'm trying to buy a duplex for $800,000, I'd have to receive $8,000 a month for rent to meet the 1% rule. But it's not even close to that. So that does not work as a cash flow market. So you want to look for areas, typically Midwest is where it tends to work the best, where the value of the property and the market rents are more in line with the 1% rule. The other two things you're looking at is population growth and job growth. You want to make sure that both of them are at least holding steady, if not increasing. And the reason is it's the same for both. If there are more people and more people each year in a market and you have the same number of units, that's going to basically create a situation where you don't have very much vacancy expense and you're able to continue to raise the rents because there's a higher demand than there is a supply. So population and job growth do tend to go hand in hand. Not always, you need to look at them separately. But if you're looking at an area where the population is going down every single year, you're gonna end up having an issue because you and all the other landlords still own the same number of units, and now there's fewer tenants to rent. And what that means is higher vacancy expense, or you're offering concessions, or you can't raise the rents because there's just not enough demand to do that. And ultimately, that's gonna hurt not just your cash flow, but also your property value. All right, let's talk about building your investment criteria. Because the way that you're gonna start looking for properties is really having conversations with brokers in all of the different markets that you've identified as good potential cash flow markets. The clearer you can be with them, the easier it's gonna be to create deal flow. So you wanna be clear on what is the property size you're looking for. Are you a brand new investor and you maybe wanna start with your first duplex or triplex? Or have you done some real estate before and you wanna do a 20 unit or a 30 unit? Or maybe you've never done real estate and you wanna do a 10 unit. There's nothing wrong with any of them. The whole point is be crystal clear on what you're looking for. And then age of property. Now, age of property for me has never been an issue. We have several properties that were built in the early 1900s, but that's not for everyone because there do tend to be more repairs over time. You have to renovate kind of over and over many, many years. So you want to know, like, where are you comfortable? And if you know that you're just not comfortable buying anything that was built before 1980, cool, then be clear on that and make sure you're giving that to brokers as part of your criteria. So they're not sending you a bunch of early 1900s buildings that you have no interest in buying. This is really going to be from your side of things, is going to be underwriting. So you want to have a certain baseline of what you know will work for you. Here's the reality. Most sellers want way more for their property than what it makes sense for us as investors to buy as a business. We're doing this as a business. It's not a hobby, so the numbers have to make sense. So you need to be clear as you're analyzing deals, you're underwriting deals, what amount of cash flow is your cutoff? What amount of return on investment? What's your cash on cash return? What kind of cap rates are you comfortable working in? Get crystal clear on those things. You can communicate them to the broker so that the deals you're looking at have a higher chance of hitting. Now, do not be afraid to analyze lots and lots of deals and see that, oh my gosh, they just don't ever work. Because that is most people's reality. It is just a numbers game. You're gonna analyze over and over and over. Just a couple of nights ago, we were having a mastermind call and one of my students came on and she was working on it, closing a 20 unit. They had it under contract, did all the due diligence. They're just looking for a couple of partners, so we were masterminding about that. When she told her story, because most people at that point didn't know her yet, she told her story. She's like, look, I will tell you that I was very frustrated in the beginning because I was like, where are people finding these deals? None of the deals I'm looking at, I can get to work. And all it was is she just hadn't analyzed enough deals. When she was able to just finally accept that it takes running more deals, she was able to find a great property. She closed on a 37 unit value add deal, and now she's getting ready to close on a 20 unit. So don't be afraid to get in there and make lots of offers. But the way you're gonna get the most properties in that are gonna fit your criteria is by being crystal clear and communicating that to your brokers. Now, where do we find all of these properties? Like, where do they live? Well, I mean, if you want to go old school, you can go drive around, look for properties, send out letters, probably get no response. That's not very efficient. We live in a different age and time. And the whole reason I even bring it up is because there's so much training out there that was from like so long ago that would say, go do things, send letters, and go drive around and look for properties and try to reach the owners. You can do all of that. But if you want to be a lot more efficient, you're going to leverage the time of other real estate brokers who are commercial brokers if you're looking for apartments, and just brokers or realtors who specialize in investment properties if you're looking for something that's maybe 2 to 4 units. So where do we find those brokers? Well, there's a couple different ways. If you're in the residential side of multifamily, 2 to 4 units, my favorite way to find realtors is to go to Redfin. And with Redfin, I'll go into their little filter. I'll look for properties that are for sale that are multifamily, and then I'll go look to see who's listing those properties. And then I'll basically Google that realtor and I'll reach out to them. And I'll say, hey, I saw your listing at 123 Main Street. I might be interested in that property, but let me tell you what I'm actually interested in buying in case you have anything else that meets my criteria. All right, so that's a really good way to find realtors if you're in the residential 2 to 4 unit. If you're in 5+ unit, you're looking for your first 10 unit or you're looking for a 200 unit, that's all the same. There's 2 websites that we like the most, LoopNet and 𝐂𝐤𝐤𝐸. And with LoopNet and 𝐂𝐤𝐤𝐸, I'm not necessarily going there thinking I'm gonna find a great deal. Most of the time, the deals on there, they're not great. However, the information that's available there is gonna tell you who the listing brokers are for the properties that are listed. So you can call them and say, hey, I saw your property at, again, 123 Main Street, and I might be interested in that, but I wanted to tell you a little bit more about what I'm looking for in case you come across something else that meets that exactly. So that's a great way to start finding brokers, and then let the brokers be the one leveraging their time to find you deals. That's how they get paid. Let them get paid. Don't waste all your time doing it. Let them do that. Now, I know there is just so much to learn. If you want to spend more time learning about multifamily real estate, we have curated a playlist of 8 really great masterclasses that we've done over the years. We've made it available. It's free. All you have to do is go to warriorsofwealth.com/podcast and click the link, fill out the form, and you're going to have 8 awesome masterclasses that are related to everything multifamily. All right, let's jump ahead a little bit in the whole process. Let's say you identified your market, you found brokers, you got deal flow coming in, you analyzed them, you made offers, and one day, you get one accepted. Oh my gosh, what do you do now? Now it's time to go into due diligence. So due diligence is the time that we are going to get to investigate everything about the property to make sure that what we think we're buying is actually what we're buying. And I'll tell you, I don't think in 21 years of investing, I've ever had a single property be in reality what it looked like on paper. Like there's always some difference, which is great because then it allows you to go back and renegotiate, right? So doing due diligence is not only critically important for you to make sure that you know what you're buying, it's important for your investors or your partners so that they know you've checked everything, you've crossed all your T's, you've dotted all your I's, and ultimately, if the price that you agreed to when you had it under contract no longer works because you found that the expenses were higher than what the seller had said, or that the income was lower than what the seller had said, or that there's $200,000 worth of capital repairs that they didn't say anything about. And you find those things out through due diligence, which gives you the opportunity to then go back and say, we like the property, we want to purchase the property, but unfortunately, X, Y, and Z are wrong with the property and we can't buy it at the price that we agreed to because we didn't know those things at the time. So doing a thorough due diligence is going to be something that's going to be a lifesaver for you on the long term, because the reality is once you close, now it's too late. So there's 2 types of due diligence. There's financial due diligence and there's physical due diligence. So financial due diligence is anything that's going to impact the financial statements, the income and expenses. So you're looking at things like the rent roll and you're looking at the leases to verify that there's a source document that supports the amount that's on the rent roll that the seller provided you, and that the amount of the rent roll is what rolls into the financial statements. So it's a bit of an audit. So you're making sure that the revenues are correct. You're also looking at all of the expenses. When you look at a T12, which is a trailing 12-month financial statement, you're looking to see, is there anything about that on any given month during the year that looks odd? And if so, you want to ask questions about it. But you're trying to wrap your arms around, how does this property normally perform? Now there's 2 numbers that are likely going to be very different for you than they are for the seller. And this is part of your financial due diligence. And that is the property taxes and the insurance. So you can never take at face value what they give you because that's what it was for them. When you sell the property, it's possible likely that the property taxes are going to go up at some point. So you want to do the research during due diligence to figure out, how does the county assess taxes? How often do they reassess? And what is it based on? So that you can do a projection that is more likely to land you with accurate numbers. All right, and then the other due diligence is the physical due diligence. So once you're done with the financial due diligence, that's free. Do that first. Then you're at the part that is actually going to cost money. And this is an investment you absolutely must make. It is a non-negotiable if you want to stay in this business long term. But you want to have a property inspector go to the property, not only look at all of the major mechanicals and the roof. If there's a basement, have them look at the basement. You also need them to go into every single unit. The one unit you don't get into is the one that you just, holy cow, gives you all sorts of nightmares that you will regret forever. So you just have to make sure that you get into every single unit and that you get a complete list of everything wrong with the property. Look, this is real estate. There's gonna be things wrong with the property. We're not afraid of that. All we wanna know is realistically, what is it? So that one, do we need to renegotiate? Or two, do we need to raise more capital to be able to handle some of those things? So it's about being informed. You know what, and ultimately, if you do that property inspection and you realize, wow, this thing needs like $700,000 worth of work and I'm not willing to do it, well, then you spend some money in order to know that you don't wanna have that giant headache. It's not ideal, but you always wanna do financial due diligence first, so that if it doesn't work that way, you don't go have to spend the money on the inspection. Okay, I just want to teach you guys everything that I know. Here's the thing. I know we're supposed to be talking about how to find apartment buildings. I taught you how to find apartment buildings. And look, I get it. It's gonna be scary those first few times that you're making the calls. Maybe more than the first few times, maybe the first 25 times. But either way, just know that every successful real estate investor before you had to do the same thing. They were afraid and they did it anyway, because there was something else that they wanted, something that was bigger. And you know what? If you want more, you must become more. How do you become more? You become more by challenging yourself, by finding something that's scary to do. It's not gonna hurt you. No one's gonna stab your face through the phone or anything, right? But you're gonna be afraid and you're gonna do it anyway. Because eventually what you'll find with those reps and reps and reps, you won't even remember what you were afraid of to begin with. But if you feel like you're the only one who's afraid, I promise you, it's like 99% of investors. I was also one of them. So just get out there, talk to as many brokers as you can. You're gonna get better and better and better every single time, and you're gonna start getting deal flow coming in. All right, now that you know how to find the best apartment buildings for sale, let's help you understand how to find the right property, how to manage it, and what major pitfalls to avoid. I made a whole series of videos that go deeper into each of these steps. Click the video that's on your screen right now, and I'll see you there.